Welcome back to the channel, everyone. Let's talk about a ticker that has taken retail investors, options traders, and Wall Street cynics on one of the most violent psychological roller coasters in modern biotech history. Amylyx Pharmaceuticals, trading under the ticker NASDAQ AMLX. As we pull up the charts here in mid-2026, Amylyx is changing hands right around $22.67, sitting comfortably on a market capitalization of roughly $2.5 billion. But if you look at the raw price action alone, glancing at a 52-week range that spans all the way down to a depressing $7.61, you are missing the entire narrative. Standard financial media and algorithmic retail sentiment trackers completely misread this asset because they are still fighting the last war. They look at Amylyx through the rearview mirror of its 2024 heartbreak when the company voluntarily pulled its flagship ALS drug, Relyvrio, off the market after a confirmatory Phase 3 trial missed its primary endpoints. To the mainstream financial press and the Reddit comment sections, Amylyx was written off as a classic one-hit wonder biotech Deadpool candidate, a textbook casualty of clinical development failure. Yet while retail algorithms were shorting the wreckage and retail investors were licking their wounds, institutional heavyweights and specialized healthcare venture funds were quietly executing a masterclass in accumulation. What the consensus missed is the structural reality of corporate reinvention and pipeline pivoting under pristine balance sheet management. Amylyx didn't just pack up and go home when Relyvrio failed. Instead, they executed one of the most intellectually honest and financially disciplined wind-downs in pharmaceutical history, preserving cash, reallocating capital, and aggressively acquiring high-potential clinical assets like Avexitide for post-bariatric hypoglycemia, which has just dropped stellar Phase 3 LUCIDITY trial results. We are looking at a clinical stage metamorphosis where the market mispricing stems from a psychological hangover. The street priced Amylyx like a company with zero future, entirely ignoring the physics of cellular stress mitigation, endoplasmic reticulum biology, and a completely refreshed pipeline, targeting multi-billion-dollar endocrine and rare neurodegenerative markets. If you track the daily order flow and block trades on Amylyx, you can see the classic institutional footprint. Amid macro jitters, sector-wide xeno-biotech volatility, and fluctuating interest rate expectations, retail traders are getting routinely shaken out by intraday shakeouts and sharp volatility spikes. When retail sentiment is driven purely by emotional headlines about past drug withdrawals, smart money is methodically building structural long exposure during quiet accumulation phases. Institutional desks understand that biotech valuations do not move in a linear fashion. They re-rate violently overnight based on binary clinical milestones, regulatory approvals, and pipeline de-risking events. While Twitter traders are arguing over yesterday's news, institutional block buyers are calculating the risk-adjusted net present value of a completely diversified pipeline that extends far beyond the company's historical footprint. Before we go any further into how this valuation model breaks down, let me pause right here and ask you, are you currently holding a position in Amylyx through this recovery rally, or are you sitting on the sidelines waiting for a macro-driven pullback to enter? Drop your average cost basis or your game plan in the comments below, because this is a name where execution timing is everything. To truly understand why Amylyx is a completely different animal today compared to its 2022 IPO incarnation, we have to break down its core operational and scientific architecture. The company was founded out of a dorm room at Brown University by engineering and biological science minds, Joshua Cohen and Justin Klee, who dared to tackle multi-target neurodegeneration by focusing on mitochondrial dysfunction and endoplasmic reticulum stress. Outdated historical framing pigeonholed Amylyx as a single-product ALS play tied to a single regulatory roll of the dice. But that legacy framing completely obscures the underlying technological platform. The core scientific thesis, mitigating cell death by simultaneously targeting parallel pathways of cellular destruction, applies across a broad spectrum of devastating conditions with massive unmet medical needs. Today, Amylyx has successfully diversified its clinical shots on goal. The portfolio now centers heavily on endocrine conditions and rare neurodegenerative conditions, headlined by Avexitide for post-bariatric hypoglycemia and congenital hyperinsulinism, alongside innovative early and mid-stage candidates like Amlx 30035 for Wolfram syndrome and progressive supranuclear palsy, and Amlx 114 targeting ALS through novel mechanisms. By acquiring the global rights to Avexitide, Amylyx stepped into a high-value therapeutic space with virtually no approved options for severe post-bariatric hypoglycemia, transforming the company from a binary clinical gamble into a diversified multi-asset biopharmaceutical engine with tangible, de-risked clinical data readouts. Looking ahead across the multi-year horizon, the catalysts for Amylyx are firmly lined up. The recent positive top-line results from the Phase 3 LUCIDITY trial of Avexitide in post-bariatric hypoglycemia changed the fundamental investment thesis, paving the way for regulatory submissions and commercial execution in an entirely new market segment. Furthermore, the advancement of Amlx 30035 into rare neurodegenerative conditions like Wolfram syndrome provides multiple independent valuation pillars that institutional analysts can model out with predictable cash flow potential. Of course, no deep-dive biotech analysis is complete without addressing the structural risks. Clinical-stage drug development is inherently volatile. Regulatory pathways with the FDA can introduce unforeseen delays. Reimbursement negotiations with payers are increasingly hostile, and capital expenditure burn rates must be rigorously managed. However, because management proved their ethical and financial discipline by returning capital and restructuring efficiently after the Relivrio trial, Amylyx maintains a fortress-like balance sheet relative to its microcap and small-cap clinical peers, mitigating near-term dilution anxiety. When you strip away the short-term price noise, the algorithmic panic, and the legacy baggage, Amylyx Pharmaceuticals represents a classic case of a misunderstood corporate turnaround. The market is slowly waking up to the fact that the old narrative is dead and a leaner, more scientifically diversified pipeline is taking its place. Stop looking at yesterday's headlines, start watching the clinical data, and always keep your eyes locked on the long-term structural value. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.